This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture saying, looking for the downloads. Eric, let's cover crude oil, starting with the EIA inventory.
EIA printed a record 17 million barrel drawdown. As far as I know, that's an all-time record, but remember the records all time, it only goes back to the 1980s or so that we've been keeping these records. I'm still pretty sure in the history of the world, there's never been a 17 million barrel drawdown in a single week from U.S. oil storage ever before. Meanwhile, the Biden administration has given up on refilling the SPR, scapegoating OPEC and changing market conditions, saying they're going to wait for lower prices that are probably not coming. So I don't think we're going to see the SPR refilled. Hey, I think I heard a podcast someplace where they predicted that. Cushing, Oklahoma, drawing down 1.2 million barrels. Gasoline building, not drawing down, but building 1.5 million barrels. That was the surprise on the board. Distillates drawing down 796,000 barrels. U.S. production holding unchanged at 12.2 million barrels. Tape action, well, there was a huge rally because the API had anticipated the inventory. It's a great big rally right up to the release of inventory. And as much as this was an all-time record high drawdown and therefore a bullish print, it was that surprise loss of demand in gasoline that really kind of surprised the market. And I think there was also a certain amount of buy the rumor, sell the news effect here. So it was right after inventory came out that the market collapsed by several dollars. But again, I think this is a case of the market just buying the rumor and selling the news. As far as where we stand in the bigger picture, these breakouts above the 100 and 200-day moving average, which are now sustained, definitely spells at least what looks to me like the beginnings of a new bull trend. And that certainly is in line with what Dr. Anas Al-Haji predicted, although he thought it would come later in the year into Q4 or maybe into Q1. Perhaps we're seeing early signs of that. I still don't discount the possibility of that blow-off top in the stock market that Darius Dale predicted. If that were to happen, it could result in a reversal of everything, and we could still see new lows on oil. But unless we get that dramatic reversal where there's a stock market crash or something of that magnitude, it looks to me like we finally have the beginnings of a sustainable rally in crude oil. I'd love to see a retest of the 200-day moving average on the continuation chart. That's right around $77 on WTI. If we were to retest that now as a support level rather than as a resistance level, and then rally back off of that back above $82, which so far has been the high in this move, those would be the signals that would tell you that we really have maybe the beginnings of a new structural bull market. It's still early to say, but I think things are beginning to look pretty good.
Yeah, Eric, I put that 200-day moving average on the chart on page 2, and I find that this is such an important moment. First of all, oil was so bearish going into June, and it really was trading along its all-time lows, just really asking the question, could we see a breakdown to 60 or 55 or something lower on the downside? And this rally throughout July just had so much bullish progress in the fact that it completely wiped out the sell-off that was occurring into the start of May. And now that we are above the 200-day moving average, this is the first sustained period above the 200-day moving average in a year. You have to go back to the first 3 quarters of 2022 to see a period where we were above that 200-day moving average. So we've had this 1-year oil bear market. And what's going to be really interesting to see is that now that we've seen this pullback over the last 24 hours, it's going to be really interesting to see whether the bulls buy the dips. and whether they can maintain that price action north of that 200-day moving average. If we see generally a bullish behavior of dips being bought and price action being well defended, then we could see this as a base during this consolidation that allows oil to go and retest some of those third quarter highs from 2022, where it was trading near $90. And nonetheless, we're in the midst of some sort of a little correction, and now it's going to be about seeing what happens next. Let's move on to equities. What are you thinking here, Eric?
Well, 46.12, which I mentioned last week as a technical level that was holding the market, has continued to hold. Now we're seeing the market, at least on Wednesday, starting to trade off significantly. If all the experts who said that this is just a bear market rally and the worst is yet to come are still going to be proven right, that needs to happen pretty darn soon. Remember, Darius Dale was one of those bears who was saying that the downside is still to come, but he also predicted that right tail risk was what was going to happen first. So far it seems to be playing out the way Darius predicted. Are the bears really going to be proven right in the end? Well, it's still early to say.
Yeah, I want to talk about that 46.12 high in just a moment, but let's get Nick involved in this conversation. Nick, obviously a big reversal here the other day on the S&P. The volatility is expanded. How do the support resistance levels look on the S&P based on the options market?
So the spot price right now is approximately 45.15 on SPX. There's a call wall above at 46.50 and a put wall pretty much right where we are right now at 4,500. The implied move for the August 18th OPEX, which is about 2 weeks away, is plus or minus 100 points. So the upper expected move is about 46.15, just below that call wall, and the lower expected move is 44.15. Key resistance is at 4,600 above. Key support below is at 4,500, 43.50, then 4,300. Now, my thinking here is that if we do break below that 4,500 mark and stay below it on close, we'd likely see a fast flush down to that 4,400 area. And that might coincide with Apple's earnings tonight if they have a weak report, which should sell the market off into tomorrow.
Interesting you say that the Apple earnings, because Apple and Amazon are going to be obviously the things to watch going in from an earnings season. And it's really almost the end of the earnings season, which really has not seen anything really bullish about it. But what I find interesting is this correction, if I go on page 4 on the S&P, started with a direct test into the highs from the third quarter of 2022, right around that 46.12 level Eric was talking about. What's interesting is that we had this upwards channel that was the decisive bull trend higher that really got us up here, but we now have definitively broken that channel. Now, typically, and very similar to the market correction that we saw in June going into early July, was this kind of 100-point drop over 4 or 5 days. And it got bought on dip pretty quickly. And right now, this pullback actually has many of the same characteristics. It's a 3-day sell-off now that's just over 100 S&P points, coming right into some very important Fibonacci zones right around this 4,500 level. This is a moment where we're going to find out whether the character of the market has changed or the personality has changed, because up until now, when we get these types of pullbacks over the last 2 months, they almost immediately get bought on dip. So will we see actually a positive reaction maybe to Apple and Amazon that maybe has this bought on dip and sends it right back to 4,600? If we see that the bulls don't show up and this becomes a deeper correction, then that 50-day moving average, which lies around 4,440, is going to be the magnet. And so that 4,400 level just down below is going to be a place where we could see some testing. But if this was a correction very similar to the December and or February market corrections, which ended up being 300 plus point pullbacks, then even a pullback as deep as 4,300 could happen. With all of that said, there is still nothing bearish about these charts. They are still very clearly in bull trend. And this is a correction that was typically expected once you have an advance as fast and as far as we've already gone. What will really be the valuable information throughout the month of August is going to be the way that dips are being bought and whether or not the bulls are able to re-achieve or regain some of these previous highs. If we see that this market becomes very distributive, larger increases in implied vols, we'll talk about that on the VIX chart in a moment. If we see that it becomes very distributive, then I'm going to get far more bearish off of these levels. But certainly, we now have established a key swing high that is going to be something we're going to be discussing in the weeks to come. With that said, let's just quickly touch on those NASDAQ levels. Obviously, the NASDAQ is going to be an important factor here because of the Apple and Amazon earnings coming out here after we recorded this. And so what levels are you watching here, Nick?
So the spot price on NASDAQ right now is 375 approximately. We have a call wall above at 385 and a put wall just below at 370. The implied move for the August 18th OPEX is plus minus 12 points. So the upper expected move would be 387 and the lower expected move would be 363 approximately. Now we have resistance just above at 400 and then at 409, which are the all-time highs, and key support just below at 370. Again, as I said in the past weeks, I do think that tech is very overextended and the multiples on PE are very, very high right now relative to historical averages. And I favor the small caps in terms of the Russell over the NASDAQ. So I'm not inclined to really buy any of these dips unless we see a substantial sell-off in the realm of 5 to 10%. And I do think we see some more downside before we see a touch of the upside. Again, it's possible we push all-time highs if we get a good report from Apple or Amazon or both. But I'm inclined to think we see more downside first.
All right, well, let's talk about the volatility levels because obviously we saw multi-year lows on the VIX as we saw even the 12 handle at one point on a couple intraday basis, but really a consolidation along the 13 level on the VIX. And everything was pretty complacent, but the last 2 days of selling have now us in the 16 and a half levels on the VIX, and certainly a return back to some of the levels we saw in the first half of the year. Do you think this is a meaningful turn up, or you think this is just a short-term blip because of the selling?
It could be a short-term blip for sure. I mean, looking at the current spot VIX, which is about 16 or so, which denotes 1% daily moves in broad markets. I mean, I touched on it last week and the week before that these low levels on VIX, we have these events that come out of left field, catalyst events, that is. So this week, for example, was the Fitch downgrade of US, which caused a spike in the VIX and also a correlating decline in broad markets. Also looking at, things like the US dollar, for example, which we'll touch on in a sec, that's rallied back up as well a little bit. So there's a confluence of events right now that are pointing to a bit of risk off perhaps as we get into the late summer. But right now, again, premiums are getting a bit more elevated, which is kind of nice if you're selling premium, which I am myself. You got to be cautious here, I would say. Now, moving on to page 7, we have the US dollar index, which I just mentioned. Eric, what are your thoughts here?
I said last week that we're right on the edge of retesting a prior support level as resistance, and I expected that resistance to hold. I thought the market would fail there and the dollar would move substantially lower. That was proven wrong this week, at least my prediction as to where it was going to go. Remember, technical analysis doesn't predict future prices. It only predicts where the forks in the road are likely to occur. And I think we correctly predicted that's where the fork in the road was going to be. I thought it was going to take the other fork. What all this means is now we have a new signal, which is a false breakdown reversing above the prior support level to reestablish the prior consolidation range. The next big tell is whether the dollar can rally above 103.75, which would signal a trend reversal to the upside. But what I find just astonishing is that the market has almost completely, totally ignored a major rating agency downgrading the credit rating of the United States of America, which no longer enjoys a AAA Fitch score as of this week. I'm reminded of Stan Druckenmiller's words of disbelief when everyone was focused on the debt ceiling extension rather than the much more pressing question of the unsustainable debt problem that we've been ignoring for decades. Prominent members of the finance community are actually ridiculing Fitch this week, while nobody seems to care that interest rates went back up just as the doomers predicted, and that compromised U.S. sovereign creditworthiness just as the doomers predicted. Don't worry, though, about the credit downgrade, folks. There's nothing to see here. Just bring on the MMT and let's spend, baby, spend until we lose that AA rating, too. And when we do, we'll just say it's only silly politics and it's not real. I think that we should take this stuff seriously, and it's really telling to me that the market has completely ignored such an important signal.
You know what's interesting, Eric, is that that dollar rally has now almost completely wiped out that July bloodbath that we had at the start, where the dollar index broke down to year lows. And at minimum, this really asks the question as to whether or not that was a legit breakdown, or whether just it was a short-term liquidity event, and that we're really returning back into that trade range that's been dominating the dollar all year long. Obviously, the one thing which I typically like to technically see is dips being bought. So now that we've seen this very robust rally, will we see that the areas where all these lows in February and April and May, which all occurred around this 101 level, will all short-term little pullbacks on the dollar stay north of 101? If we see that the price action remains in the trade range that was established all year, then it may end up proving that the dollar breakdown wasn't really a breakdown at all, and that the trade range is the prevailing force.
And moving on to page 8, we have the chart of the gold futures. What are you thinking here, Eric?
Well, you'd think that if gold's major competition is the U.S. Treasury market, and that got a credit downgrade this week, well, that ought to have caused any rational investor to say, hey, gold's a better deal than Treasuries because it didn't just get downgraded by a major rating agency. And by the way, it can't get downgraded because it doesn't have any contingent liabilities. But there's no luck there this week. As I've said before, I think the Fed policy is going to prove more hawkish than most participants expect. That, not the fundamental factor of U.S. Treasuries being downgraded, is what's going to present a headwind for gold. I'm still hoping for a dip to 1860 or lower so that I can add to my long position. Longer term, though, I couldn't be more bullish.
And what's interesting to me is that the bull scenario that I had for gold and silver really were anchored, obviously, on two factors. One is this pullback in rates, and two, in the U.S. dollar continuing to weaken. And simply neither of the two have manifested. We continue to see higher yields and the dollar strengthening. If this was a false breakdown in the dollar, and it just may mean that gold is likely to continue to be trade range bound. While I do think that there's a bull cycle coming in gold, question is, does it come when the next easing cycle starts, which could be many, many, many months away? So right now, with gold failing at this 50-day moving average, which I have on the chart, the bigger question is, will we see a break of those June-July lows? If it does, a consolidation over the span of the third quarter, where gold can retest February-March lows as it remains muddled in a period where we might see a little bit more risk off in the broader markets, may be what comes around. Obviously, let's watch what happens in the dollar, and I think it'll tell a lot about what's happening in gold. I want to move on, though. On page 9, I have a chart on copper. And what's interesting is that we had a very definitive breakout attempt above $4 on copper, which was decisively rejected. And while the ascending trend line, which I've drawn on here, has not been broken to suggest that copper is bearish, it certainly was a false breakout. And one of the things to watch on copper is whether this trend line does get broken, and whether or not copper is destined to somehow go and retest the lows from May and June. I at this moment, was giving the bulls the benefit of the doubt, but they really have to show up here and push this right back toward those highs in the coming week, because any further weakness here is just going to mean that copper has to wait a little bit longer in that cycle. Finally, though, I wanted to, on page 10, just touch on that, just the market breadth. And this is using the New York Stock Exchange, the percentage of stocks above their 50-day moving averages. And really what it does is it just really shows how the market cycles through periods of large distribution to broad rallies. And we've gone from back during the regional bank crisis where over 80% of stocks were decisively being distributed in a downtrend, to now the reverse, where we had a very strong uptrend where 80-85% of stocks were very bullish. And this cycle tends to very well demonstrate the kind of expansion and contraction cycles. So now that we've been this overbought, we're obviously due for a pause, and it really is interesting to see that it is reversed here. And the question now is this a swing high in the markets? Obviously, we talked about the S&P already. It'll be interesting to see what happens in the coming days.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.